Welcome back, everybody. So today I have a special guest. So I'm extremely honored to have Brendan, who's the Chief Investment Officer of KraneShares, to talk a little bit more about China, especially when we are experiencing such tumultuous time. So welcome, Brendan, to my channel. And maybe to start off, Brendan, you might want to share what you've been doing and your job scope at KraneShares and what's your day-to-day like to my audience.
Yeah. Then certainly very much appreciate the opportunity to connect. You know, KraneShares is a provider of exchange traded funds in both the United States as well as in Europe. You know, the firm itself was founded by Jonathan Crane, our founder and CEO, who had lived in China beginning in the early 2000s, where he built a successful business geared to China's growing urban middle class. Now, the year he got to China, 2001, coincidentally, was also the first year that Chinese financial regulatory bodies allowed foreign investors into the A-share market, the Shanghai and Shenzhen market. And after creating a successful business in China, he ultimately sold that business to a global multinational corporation. Goes back to New York. Can't believe how much the exchange traded funds industry has grown. But when he looked at the China ETFs, as well as China's exposure in indices such as MSCI emerging markets, he noticed it was all old economic sectors. It was all financials, energy, industrials, materials, real estate. And there were no growth sectors. There's no growth stock exposure. And the definition of China for foreign investors was only Hong Kong stocks. So Jonathan studied the ETF industry and started down the path of creating KraneShares, a China-focused ETF provider. I got introduced to Jonathan in 2012 through a mutual friend. I had been hired by Barclays Global Investors in 2001 when they created the iShares family of exchange traded funds. And so I moved from New York out to San Francisco to be part of iShares. And that business was a tremendous success. You know, probably one of the great success stories of asset management. But our parent, Barclays Bank, got in trouble and sold iShares and Barclays Global Investors to BlackRock. So I had moved back to New York and worked for BlackRock, and great firm. But I was very interested in doing something entrepreneurial. And when Jonathan articulated his views, a big part of it to me was, Jonathan spoke about this Shanghai and Shenzhen market, giving more access to foreign investors. And from an index, from a passive investor's perspective, I thought about it. If you have the second largest stock market in the world and it gets added to these indices, all of these investors are going to have to buy it. And so I quit my job to help make Jonathan's vision investable. And we, continued to broaden our suite on China growth. So, KWEB, our China Internet, has been our kind of flagship fund, but we have China Healthcare, China 5G, China consumer buys. We have A-share access, Starboard access. But we've also taken things in China that we see happening globally, such as we did the first electric vehicle ETF globally. More recently, we've, with the emphasis on climate change, we did the first carbon credit allowance ETF. But the roots of the firm are really around China. And I think the most important thing we do is try to provide investors with good research to understand what's happening in China in terms of the economy and capital markets. And that's where I write a daily research blog called ChinaLastNight.com. So yeah, I think it's been a great business to be part of and to travel to Asia and China has been, just, unfortunately not done recently, but hopefully that comes back online soon.
Right, that's a great history sharing about how KraneShares actually was born and evolved over the years, right? So maybe to just allow my audiences to know yourself a little bit more. So what got you first interested into managing or just dabbling into China? Because it's always seen as like the risky country, and you have all the standard manifestations of ideas, especially in the West. So what got you first interested in dabbling into Chinese investments?
Well, I've always loved the stock market. As a teenager, I first read Peter Lynch's book called One Up on Wall Street, and my grandmother and grandfather loved the stock market, and my father always would read the Wall Street Journal every day, and so I got interested and knew this was what I wanted to do. And I had worked in New York City for asset managers, and then really fell into this role, this opportunity with Barclays Global Investors and being part of iShares at the beginning. But I think for China, it's something that I've always had an interest. I've always personally loved to travel. I always love to learn and read books and learn about history and learn new cultures and try new food. And I think China is such an important part of the global economy, for global relations. And yet a lot of times there's misunderstandings that I think for Westerners in particular, there can be, there are cultural differences that, for thousands of years, Asia, developed with its own standards and cultures, which are not they're in ways they're similar to Western kind of European standards and American standards, but in ways they are different. And, I think we all have to learn how to understand each other. And there's no better way to learn about people than getting on an airplane and going, seeing and doing it and experiencing it yourself. And I've had just a fantastic journey getting to know China, but at the same time, broader Asia. And hopefully we'll be back to traveling soon so we can do this in person.
Right. I think also I wanted to take this opportunity to really thank what KraneShares is doing. I think it's quite underrepresented, at least on the world stage, into introducing and trying to bridge the differences. And definitely it will be an uphill battle into trying to bridge the different cultural differences in terms of thinking, and more importantly, to give people or give retail investors access to all these different investment instruments as well. So maybe just to segue into China specifically, I think a lot of people are interested into understanding your perspective, especially just to paint a little bit of context for viewers that are listening. Specifically speaking, I think Chinese investments haven't had a great time, both A shares and even H shares or their ADR's counterpart. So a lot of them were down, a lot of them are near their all-time lows. And more importantly, in today's dynamic context in China, there are a lot of issues that is prevalent in the entire market. So you have your COVID strategy. Currently, it started at Shanghai, and then now it started spreading to Beijing, and there are even rumors of more lockdowns in other provinces and states. Then you have a lot of economies initially stating that maybe there's a 5% GDP growth for China, but many of them are currently slashing headlines after headlines because of the lockdown. And then there are mass retrenchment by all the top tech companies out there, Alibaba, Tencent, Meituan, all of them are kind of trimming off some of their workforce. And also this idea of capital flight, right? Because flight to safety, especially when the world is in a rather hot mess, if I can put it that way. So I really just wanted your take to understand what do you think of whatever is transpiring thus far, and what's your read of the entire situation in China, and specifically for Chinese investments?
Yeah, I think there are macro factors at play. You have a value rally driven by higher commodity prices and the specter of not only U.S. Federal Reserve interest rate hikes, but many many economies, such as in Europe, moving away from an easing to a tightening policies, and that will put pressure on elements of stock markets globally, as well as you've got this value growth rotation where over the last decade investors love growth stocks, but higher interest rates do pose a challenge really to profitless technology companies in particular. But I think specific to China, it's interesting that one of the ways that I think it's important for investors when they think about China is differentiating the A-share market, the Shanghai and Shenzhen stock exchanges, which are predominantly owned by investors in China. And those markets in 2001 held up pretty well. That the Shanghai and Shenzhen were up about 9 and 11.5%. And that was driven by those markets because they're dominated by local investors. It's more of what do the Chinese think about China? And we can contrast that with Hong Kong and US listed shares. And that's the definition of China for foreign investors. And so you had those markets in 2021, the Hang Seng index was down a little more than 13%. KWEB, our China Internet ETF that holds Hong Kong and US ADRs, was down almost 50%. So what, you had this huge disparity from different types of investors based on where they were investing in China. And what was driving that was a big disparity in sentiment. And to some degree, some of the factors that have weighed on foreign investor sentiment have weighed on domestic Chinese investors recently. And that would mainly be around the lockdown and quarantines that we've seen, the effect that has on consumer consumption, that households will be conservative, just because if you're worried about having to go through a lockdown, you're going to be conservative in your spending. So I think what's interesting is the internet names in Hong Kong and in the United States were really weighed down by the implementation of internet regulation in China. We have this Holding Foreign Companies Accountable Act, where due to a long-running dispute on audits between the US and China, it's feasible that you could see a delisting of ADRs. But we also had other factors such as tax loss selling in the US. And then in the early part of this year, you had the concerns that sanctions that we saw applied to Russia, could that be applied to China? That this was a risk, investors hadn't had to worry about. So we've had this sum of all fears really on the Hong Kong and US names. And I think there's some positives we're seeing. We just need some more proof. And I think ultimately what we need to see in China is a very strong vaccine, that there is not an mRNA vaccine. We know that dozens of companies are working on it. 2 more companies announced today that they are working on an mRNA vaccine and to have it to go to clinical trials. So I think that will be a strong catalyst, as well as a potential solution on the Holding Foreign Companies Accountable Act, that it's clear the US and China are trying to resolve this issue, and it's certainly a solvable issue. So there are some positive catalysts that investors are waiting to see more tangible proof that could really be a springboard kind of. A lot of the internet names in particular have been really depressed, and to me they're almost like a spring ready to a coil ready to jump. We just need to see some tangible evidence, but I think we're getting closer.
Right. I think also wanted to differentiate, right? When we are currently participating in the markets, we are going through this entire emotional turmoil. But we know that at the end of the day, if we were to zoom out and we were to stretch our time horizon, a lot of all these lockdowns and this understanding of like have car, things will kind of pass on as time leads by. We have to settle out and they let them iron out some of the kinks. But maybe also to tap a little bit more onto your medium and long-term outlook for Chinese-related investments, maybe not specifically to Hang Seng only, even in the Shanghai and to the Shenzhen Stock Exchange as well, where you look at the entire basket of Chinese investments, right? There are certain structural issues that cannot be solved. So things like you floated the idea of this idea of sanctioning, where nobody initially had that clue of, one great power can essentially just block another great power or another great country out. And in this case, these are considered structural in nature, where you can't really solve it within 6 months to a year. So how do you see the medium to long-term outlook, maybe for the end of this decade for Chinese investments?
Well, I think China's economy will continue to grow. It's not going to grow at the double-digit rates of GDP growth we saw, a decade ago. But the value of China's GDP has never been higher. That even at, if it's 4% or 5% or 5.5%, China's economy will continue to grow. China will continue to urbanize. Chinese cities will continue to get bigger as elements of the population migrate to cities and get access to living in apartment buildings with electricity and running water and access to services like education and healthcare. So I think the growing urban middle class will continue to grow. And I think that presents great opportunities for investors in China. At the same time, China will need new technologies. It'll need the companies that are listed on the Star Board. It needs more semiconductor chips, no different than US companies or European companies or Singapore companies. So we think that there'll be a continued technological upgrade, as well as a continued opportunity around China's growing urban middle class. And so I think those things do all happen. It's not going to be a straight line. It's going to bounce around. And I think you bring up a great point, Qikeng, that as investors, we have to volatility adjust our positions in these securities or in these ETFs. That many emerging market countries, such as China, the stock market can be volatile. And so as an investor, we need to right size our positions when we make an allocation to be able to ride out this volatility. So if we think about the standard deviation, what's the volatility of an investment? Chinese stocks are going to be more volatile than European or US stocks. Now, volatility can be a good thing when things go up, but when they go down, that's a problem. And so we need to ensure when we put on a position that it's of an appropriate size, that we can handle that volatility, if it's good or bad. And I think that's a lesson that's really been reinforced over the last 2 years. 2 years ago, KWEB had a very, very good year. Chinese internet stocks had a fantastic year, but that was followed by a very poor year. And so, I think many investors, they thought about the good times, but you also have to go in thinking about areas or time periods where you have down performance as well.
Right, that's a very good segue to where we want to discuss next. So you pick up specifically KWEB, And I think a lot of my audiences are quite interested in KWEB because personally, I also do have exposure. So this is just a disclaimer to everyone that's watching. Maybe I might be biased in terms of my discussion. Yeah, you were saying?
Well, I own it as well, in full disclosure.
Right. So in this case, right, we also understand that KraneShares do offer a whole host of different ETFs, right? A lot of those thematic ETFs ranging from 5G to semicons to different healthcare sectors, etc. So KWEB is I hold KWEB quite close to my heart because I started a dollar cost averaging strategy since last year. So I wanted to dissect a little bit about how the ETF is structured and maybe take your understanding on some aspects where some of my viewers are actually quite concerned and interested to understand from your perspective. So we know that crackdown was the theme for China, right, in 2021. And the internet sector was essentially the main protagonist in how a lot of your data privacy, your algorithms, and how they manipulate. And then there's a lot of fines here and there, anti-competition, etc. So just now we were discussing more about the outlook of different Chinese investments. So now if we were to zoom in to just internet sector alone, what do you think would be, or what do you think would be the near-term outlook for these companies, at least in the coming 3 to 5 years? And how do you position and see this entire internet sector in China?
Yeah, I think these, the stocks have come down in a matter that, for investors like myself and like yourself that are focused on the fundamentals, the actual how are these companies performing in terms of their operating metrics, their valuation metrics. It's been hard to understand, when you listen to the quarterly earnings calls, to understand why are the stocks down so much. But I think you have to understand that many investors have been almost forced out of the stocks. That if you're a Western mutual fund manager, you don't really understand what China was doing with internet regulation. That your perception was China's trying to kill its tech darlings, that it's going after them like it's like going down a list. And it felt that way because every week it was like a new company fell under the scrutiny of the regulators.
It was a crazy week.
It was something else. Good to forget. But that forced a lot of institutional investors to bring down their weights in these stocks. And there's data that shows that global emerging market mutual funds have half the weight in companies like Alibaba and Tencent versus the index. And that's simply, professional investors being so worried. If I own these names, my clients might think I'm not doing something right. I'm not doing my job. And then you combine that with the Holding Foreign Companies Accountable Act, where the SEC, is really the enforcement agent for what's become U.S. law. And that law says that if the Public Company Accounting Oversight Board, the PCAOB, can't visit the auditors of US listed Chinese ADRs, they could be delisted in 2024. And I think for many investors, they'd say, why would the US delist 2 trillion of global and American investors' savings? It's not rational. But I think over the last year, there's been an understanding that the SEC, the US financial regulator, is simply the enforcement agent. It's not their job to interpret the law or opine on it. It's simply to enforce it. And I think that surprised many investors that this could actually happen. And then at the end of 2021, you had tax loss harvesting in the United States, where US investors, if they sell a stock at a gain, they can sell a stock that's down and use those losses to bring down their tax bill. So in November and December, you had another indiscriminate seller in the individual stocks. And then, in the beginning of the year, things had stabilized, but then you had the Ukraine situation, a very terrible situation, what's happening there. But, there was a worry that, could, Europe and the United States, could they sanction China like they could Russia? Now, I think, China is very, very different in terms of being so integrated in the global economy and global financial market, whereas Russia was a very small percentage of investor capital, corporate capital, a very small player in the global economy, clearly important when it comes to commodities and natural resources, but a very limited scope, and certainly relative to China. So I think, a sanctioning of China would really cause almost like a global depression. It would be a terrible, it's just not conceivable. And if you think about, how many American companies have a significant exposure in China, Apple and Nike and Boeing. So I think that fear was a little, the market's reaction seemed a little overdone, in my opinion. So I think the last year there's been this, I call it the sum of all fears. It's like every conceivable risk. And, that the price and the valuation levels today, I do believe have been depressed, but investors, many of these institutional investors will want to see like a tangible solution to the Holding Foreign Companies Accountable Act. They'll want to see an improvement in US and China political relations. They'll want to see, the movement away from lockdown and quarantine policies, potentially driven by a strong COVID vaccine in China. And I think those are all the catalysts that we need in the space today. I do believe that.
Right. I think I also wanted to echo similar sentiments about sanctioning China. I think we are no longer in elementary school. There are a lot of ramifications across the board on what are the immediate and the long-term impacts about trying to sanction a country like China compared to sanctioning Russia. Yeah, so maybe to pivot a little bit more about the ETF's makeup and the profile of the ETF. So for those of you who don't know, I think KWEB is actually incredibly concentrated. I think if you were to open the fund fact sheet, right, I think the top 5 companies in the top 5 holdings of that particular ETF, Alibaba, Tencent, JD, Baidu, and Meituan, they make up around 40% of the ETF's position. So maybe I wanted to pick your brain a little bit about how you determine the position size, and what's your framework that guides picking and why this particular allocation and this on this company?
Yeah, the original thesis on KWEB back in 2013 was about providing investors exposure to the companies that are the transmission engines for domestic consumption in China, that a third of all retail sales flows through the companies in KWEB. So KWEB was built to hold US as well as Hong Kong listed securities. And we also took a different approach of focusing on bottom-up kind of analysis of subsectors that are important to this online domestic consumption story. And so KWEB, the weighting is based on the free float market cap of the companies. And every 6 months, we weight the top companies that the number 1 company is weighted at 10%, number 2 at 9%, 8, 7, 6, and then it drops down to 4, 3, etc. So it's weighted in a way to actually try to limit, this Alibaba and Tencent are so big from a market cap perspective to try to make the exposure a little bit more balanced, but it also is really geared to give people exposure to really the whole ecosystem of internet in China. So you've got e-commerce companies like an Alibaba and a Jingdong and Pinduoduo and Vipshop, to an ecosystem company like Tencent with WeChat, and but also online gaming companies like NetEase, but online video companies like Bilibili and others. So it's built to try to say, picking the winners across these companies could be really difficult, and give investors a vehicle that really owns them all, so that with a single trade you can have exposure to one of the most important trends in China today.
Right. I think it's really true. For people that haven't been to China before, most probably they've heard of the two dragon heads of China, which is Alibaba and Tencent. Whether you use their apps, you play their games, or you use Alibaba.com to do your e-commerce drop shipping, etc. I think especially so for international viewers and international audience. So I think just the last part on KWEB, I posted on my community tab on my community post and asked if what my audience were interested in, and unanimously, I think there was quite a lot of concerns about particularly about the expense ratio and the maintenance fee about KWEB. So currently it's hovering at around 0.7%, if my memory serves me right. So arguably it's relatively higher compared to some of your other counterparts, maybe from BlackRock, Vanguard, etc. So just wanted to ask what justifies this expense ratio?
So historically, the fund's expense ratio was really driven by, it provided unique exposures to the US as well as Hong Kong names, and the cost for holding Hong Kong stocks in terms of custody costs were a little bit higher. One thing that is important is that within the portfolio, we do lend out the stocks via securities lending, and that revenue, the vast majority of it, actually goes back to investors. So US laws don't allow us to say that the expense ratio minus this revenue that comes into the fund is really your net fee. It's just kind of a funny law in the US that they don't allow us to tell you exactly, but and part of that is because the revenues generated from securities lending can vary, month to month or year by year. So it is variable. But I would say in many years, investors are paying significantly less than that expense ratio due to the majority of the lending yield being returned to shareholders. The other part, just in general with ETFs, is that you pay the expense ratio, but you also pay trading costs. And obviously your broker can charge you a commission, but you also trade bid-ask spread. So you might have an ETF that, because it doesn't have very high trading volumes, you might pay a wider bid-ask spread. And so, KWEB, because it's become a bit of a liquidity phenomenon, your trading costs in terms of that bid-ask spread are very, very low. And so, you almost have to think about your total cost of ownership of an ETF would be, the expense ratio minus the securities lending revenue, and then plus the basis points, the percentage of bid-ask spread. And that's where, at first glance, the fee on KWEB might look a bit higher, but from a total expense ratio perspective, it's much more competitive.
I wanted to kind of have a summary for for KWEB specifically. So if we can have a very quick summary, do you have an elevator pitch for people that are interested for KWEB and to reach out to?
I mean, I think the core thesis, the original thought process behind KWEB was to provide investors, broad exposure to the companies that are the transmission engine for domestic consumption in China as it occurs online. That as China's urban middle class adopts mobile technologies, that increasingly their phone is their wallet. It is how they conduct so much of their financial and consumption. And so KWEB was really built to provide investors a diversified tool to be able to gain exposure to one of the fastest growing elements, not only of the China market, but to global equity markets.
Right. I think for those of you who are more interested, you can just Google KWEB. That it will be the first Google search result. So maybe I just wanted to pivot a little bit more into the discussion. I believe you have heard of this term before, right? Once bitten, twice shy. So I think over the last 15 months or so, there were a multitude of different investors that lost a great deal of capital in terms of permanent capital impairment, especially if they were to invest in companies like education, especially the ed tech industry, and even so-called now the different tech companies that we hold. Even though we like to convince ourselves that, hey, it's paper losses, you haven't realized those losses. But inevitably, people will still feel a little bit jittery, and a lot of investors have lost faith in investing in China. So you've brought out a few good points into understanding from institutional perspective on what they should look forward to. You talked about a tangible solution about the different lockdowns, improving political relationship, and the movement away into how they're trying to pivot and a new strategy moving forward and to provide more clarity for investors by and large, right? So personally, do you think that this loss in faith would be permanent in nature or temporary or transitory in nature? And more importantly, because this is my personal position, I'm not too sure about yours, but my personal position is I always view, because the markets always operate in cycles, right? This current bad sentiments in China probably also operate in cycle. We can see that this entire regulatory tightening, usually there was this study I've forgotten done by one of the investment bank. They approached it from a Z-score perspective, and right now we are at the peak of that particular crackdown, and the markets also work in those kind of cycles. Whenever they tighten, the market falls. Whenever they loosen, the market soars up again. So I just wanted to know your perspective into the faith of international investors, and also do you think there will be this new resurgence of regaining confidence of this specific capital flowing back to China?
Yeah, certainly it's difficult to predict, what the market will do in the short run. But, for investors with the medium to long term, I do believe that original core thesis for why KWEB was created is very much alive and well. And I do believe that the companies themselves, when you look at the fundamentals of the companies, the valuations, that shows that the companies themselves, just based on the buyback programs where many of the companies are buying back stock. Alibaba increased their buyback from 15 billion to 25 billion. Tencent has been a buyer of their stock last summer as well as earlier this year. Baidu was a big buyer of stock last summer. So I think the companies themselves believe that the stock prices are low. And I think, many investors saw, the great value investor, Charlie Munger, actually buy, Alibaba's stock as a sign that the market was maybe depressing the value of these securities to very low levels. And at the same time, I think some of the things that have weighed on investor sentiment, the Vice Premier Liu He's speech back on March 16th, where he spoke about addressing some of these concerns. And we know this pivot in policy will take time to be implemented by the different regulatory bodies. But and we even saw the PBOC recently speak about how the platform economy stocks, the Alibabas and Tencents, and that they should be regulated, but they ultimately shouldn't be put out of business, and that any regulatory action should be well communicated, very similar to what the vice premier had said back on March 16th. So I think what investors want to see are really some of these tangible actions. If it's monetary and fiscal easing in China, if it's a holding foreign companies accountable solution, a solution to that issue, if it's a very strong vaccine in China that can see a movement away from the lockdown and quarantines, as well as more policy support for consumption. And we've seen some recent releases from the State Council about trying to raise domestic consumption in China. So that will allow, many of these internet companies are the net beneficiaries of those policies. So I think again, a lot of the drawdown, is really been, and professional investors, institutional investors having to kind of reduce their positions because of all these negative headlines. And I do think that, back in the late 1990s, one of the greatest investors of all time, Julian Robertson, he was short internet stocks during the US internet bubble. And he had a great, he ultimately had to close down his hedge fund because, he basically said, the market can stay irrational longer than, I could stay solvent. That he kept trying to, add, saying, these, many of these companies were very, very overvalued, but because it took, really 2 years for that situation, unfortunately, by the time he was proven correct, he was out of business. And so I think, similarly, we have a situation where you have the market, potentially much more concerned about, how these companies are being affected. And certainly there's been some situations like the online education situation. But in general, when we look at, the rate of sales growth, the net income, the cash flows, the free cash flow yields of these companies, we do believe there's an opportunity today. But at the same time, we can't plant the flag and say, this is the low. Hopefully March 15th was that low. And things appear to have stabilized a bit, but it's market timing and day trading is very, very difficult. And that's why we're more advocates for a longer term perspective.
Right, I think it's true. Based on the sentiments and quote unquote irrationality of the market, stocks can stay overvalued for a long time and can stay undervalued for a long time. But I think as long-term investors, we always like to convince ourselves that we have a long-time horizon. Let the market test investors out. So I think I can't help but want to ask this question as well, because a lot of my viewers, a lot of my audiences are all back holders of Alibaba, if I can put it that way. I have a core focus in terms of covering Alibaba related content. So barring the fact that KWEB's exposure now, Alibaba is the highest, sitting at around 11% odd. There are a lot of viewers that are interested into understanding your perspective about Alibaba, and maybe if you can shed some light in what you think what you think about Alibaba currently versus a lot of its counterparts in today's market.
Yeah, I think Alibaba, has a very, very strong management team that's been with the company for a very long time. And I think, Alibaba is so geared to the China consumption story that it certainly has taken on a very prominent role with their Lazada, their Southeast Asia e-commerce efforts, they do have some exposure outside of China. It's relatively small in terms of aggregate revenue and net income, but it isn't a growth engine, as well as they've moved up the tech scale in terms of the Ali Cloud solution. They still own a third of Ant Group, the mobile payments. So I think Alibaba, I'm a big believer in the company, and I'm a big believer in the company's prospects, and I'm a big believer in the management team that they have in place. I think what happened to the stock is very different than the fundamentals. That from a fundamental valuation, the stock is 2 standard deviations away from its historical value. The stock is actually, Alibaba's now the number one stock in MSCI emerging markets value. So this great growth company has been so depressed, so pushed down, that it's now considered a value stock, and that seems very strange to me. So I'm a big believer in the company. I think what's happened with the stock does show some of the risks of having too much of a position in one company, and it's nothing against Alibaba. But that movement we've seen in Alibaba, it's been a very significant fall in the share price, and there's an argument of why many of the things that have weighed on the stock are not driven by the company's fundamentals, but more of the fear, really driven by negative headlines and things that the company can't control. And certainly the company, I think, is telling us as investors that the stock is inexpensive just based on their buyback program, as well as by putting cash to work. The company is telling us that potentially the worst is over. Maybe the internet regulatory cycle is over, because if you felt like regulation could put you out of business, you'd hoard cash, not spend it on buying back stock. Now, I think one thing that to note is we have migrated to Alibaba's Hong Kong share class due to this delisting risk, and we've moved a lot of KWEB's exposure, Alibaba, Baidu, Bilibili, JD, and NetEase. We've moved to the Hong Kong share class due to just to mitigate the potential delisting risk. So again, we don't have a definitive solution to the Holding Foreign Companies Accountable Act. I think there's a clear desire for the two sides to try to find a solution, but that's still a risk. And for many potential institutional investors, until they see a definitive deal, they might be hesitant to come into the stock for that reason.
Right, Brandon, thank you for your insightful sharing. I think the conversation was extremely meaningful, and I believe many of my audiences will have many things to take away. So maybe just a last question to summarize this entire discussion. I just wanted to get, from your perspective, a high-level view of what are you currently closely monitoring? In essence, what keeps you up at night today?
Well, probably like yourself, we work really hard. So usually sleeping at night is not too difficult. But, I think, certainly, for myself, we've been invested in these securities, going back to 2013. And so we've been a little battle tested that, in the summer of 2015, the Shanghai and Shenzhen market, the A-share market, had a very difficult summer, had a very dramatic fall. So we've seen, we've experienced some of these significant drawdowns in the past, and for not every investor though might have gone through that experience. So some of the market volatility, I'm not immune to it, that you have to kind of detach yourself a little bit emotionally from things you can't control. So I think policy error is always a risk for investors. That we've seen in the case of Holding Foreign Companies Accountable Act, that the Chinese companies didn't do anything wrong. The investors in their stocks didn't do anything wrong. That this is a disagreement it's been going on for 10 years. So to some degree, we're held captive due to something we can't control. Certainly from a macro perspective, many investors will be watching what the Fed does in terms of interest rates. And then I think, we'll watch very closely to see what economic policies are rolled out in China, because I think one of the reasons we've become more constructive on the consumer in China is you have this, the lower efficacy rate of some of the vaccines, but the potential for an mRNA vaccine, and hopefully we'll see that at some point soon. But I think we also believe that China as the world's factory has been kept busy because of global stimulus. That as governments globally eased due to COVID and did stimulus, people went out and bought iPhones and new laptops and computers and televisions, and Peloton bikes, and those goods, or an element of those goods, are manufactured in China. So China's economy, has really been supported by very strong manufacturing, particularly export-driven manufacturing. Now, as governments globally move away from stimulus, that will lessen the demand for China's exports. And therefore, what are the things policymakers in China can do to make up for that slack? And that's where it has to be domestic consumption. That yes, there's things you'll do to support the real estate sector, but we're not going to see an infrastructure build out like we saw after the global financial crisis. Domestic consumption is really the key for China's GDP this year. And that consumption has been tempered due to COVID. And I think you see the circumstance of what's happening in Shanghai, and hopefully Beijing can avoid that situation. But that will make households very conservative. And again, it really is about having a very high efficacy rate vaccine, but domestic consumption has to pick up to help offset some of the weakness we'll see in manufacturing. And that's where you see evidence. If you look at the PMIs, as they come out on every month, I always go in and look at, you can actually view and see what the different segments and export orders, the rate of growth is falling. And if you think about your own activities, you bought a TV or a laptop or a new iPhone, you don't need a new one. So that demand, kind of got pulled forward, and we'll see that slacking and the knock-on effects. But again, domestic consumption has to be a key contributor for this year in China, 100%.
Right, Brandon, thank you once again for this conversation. And I think if people want to find out more about you or KraneShares, where should they head to? And maybe any concluding thoughts at the end of this entire discussion?
Yeah, certainly, we provide a wealth of research on KraneShares.com, our website. And then, we write a daily research blog called ChinaLastNight.com. where we want to provide investors really up to the minute updates and what's happening and affecting the securities and the economy. So yeah, it's certainly, we're big believers in our research, and I think that's ultimately, we endeavor to earn the trust of investors through our research, that we do something that's a little bit different than other firms. And certainly very much appreciate the chance. I'm sorry we can't do this in person, but I know they started the flight between the United States and Singapore recently.
Yeah,
so
they did.
A very positive sign, and hopefully we'll be able to do this in person very soon. Hopefully not in the too distant future.
Yeah, I look forward to the opportunity as well. So with that, I'll see you guys in the next video. More importantly, I will see you on the moon. Goodbye.